All right, now we are going to discuss the second thing within the IAS-12, and that is the deferred tax. Now, all of you know that when we prepare the financial statements, when we prepare the financial statements are prepared on the accrual basis. An accrual basis simply means income and expense should be recorded in the period to which they relates, and not on the basis of the cash receipts and the cash payments. We are not going to see whether the interest which has been accrued is paid or not. If it is due on you, you are going to record that thing as an expense. If the interest receivable has been accrued, you are going to record that interest receivable as an income, irrespective of that being received. If you have the utilities that is being due, you're supposed to record that utilities as an expense. So income and expense should be recorded in the period to which they relate and not on the basis of the cash payments and the cash receipts. So the financial statements are prepared on the accrual basis. And when we say accrual basis, there are a lot of things within the financial statements that is either non-cash or there is no outflow or inflow of cash related to those items. For example, you talk about the depreciation. Now we know the depreciation is recorded as an expense within the statement of profit loss. Have we made any payments in respect of the depreciation to someone? No, this is an expense, which is a notional expense. This is a non-cash expense. Similarly, you talk about the amortization. The amortization of the intangible asset is a non-cash expense which you have recorded within the financial statements. Simply, you talk about the provisions where the outflow is probable. For example, there's a litigation on the company and they may lose the case. We know the outflow is probable. So we have recorded the provision as an expense and the liability, but there is no actual outflow yet related to those provisions. So there are a lot of things, etc., within the financial statements, which is either the non-cash in nature or there is no inflow or outflow related to those payments yet within the financials, related to those items within the financial statements. But the problem is that the tax authority deals with the things on the cash basis. Now, when we say the cash basis, that simply means the cash receipts and the cash payments. They're going to accept the expense when it is actually being paid. They're going to accept the income for the tax purpose only if it has been received. And if it is not being received yet, they're not going to take it for the tax purpose. If that expense is not yet paid, they're not going to take it for the tax purpose. So generally speaking, the tax authority deals on the cash basis, and you prepare the financial statement on the accrual basis. So based on the accrual basis, you are calculating the accounting profits. Based on the accrual basis, you are calculating the accounting profits. And based on the cash basis, after doing the adjustments, you will be calculating the taxable profits. So using the accrual basis, you will be having the accounting profits. Using the cash basis, which the tax authority is dealing with, you will be having the taxable profits. Now, there will be the difference between these two, and this will give rise to the differences. And there will be future tax consequences There will be future tax consequences due to the difference between these two, the accounting profits and the taxable profits. So the deferred tax is the estimated future tax consequences of transactions and events recognized in the financial statements of the current and previous period. And these differences are due to the difference between the accounting profits and the taxable profits. So when you have calculated the accounting profit, this is based on the accrual basis. Using the cash basis, you get the taxable profit. There will be the difference between these two. And as a result, we will be having the differences. And these differences are classified between the permanent difference and the temporary difference. Temporary difference is a difference which is a temporary thing, and it is going to be settled in the following accounting years, in the future years. Anything which is not accepted by the tax authority now will be accepted by them in the future. For example, there's an expense which is not yet paid, so they will not be taking that expense into account. But when that expense will be actually paid in the following years, they will obviously be accepting that. Similarly, there's an income which you recorded based on the accrual basis, but that income is not yet received. The taxation authority is not going to accept that. But when you receive that income in the following year, the taxation authority is going to accept that. So simply means both of you, the company and the taxation authority, is accepting that thing, is recording that thing, but within the different accounting periods. You're recording it now, they're accepting it in the following year. So a temporary difference arises when an expense is allowed both for tax and accounting purpose. You're recording within your financial statements, even the taxation authority is accepting that, but within the different accounting periods. So that is why it is named as temporary difference. This difference will be settled because it's temporary. The other version of the difference is the permanent difference. And as the name suggests, this difference will not be settled as it is a permanent difference. The taxation authority is not going to accept that even in this year. Now, in the future, no, they are not going to accept that thing at all. There are a few things which the taxation authority is not going to accept. For example, if you have studied your F6 paper, you know that. The example of that is the client entertainment expenses and the fines. You may record that thing as an expense with your financial statement, but the tax authority does not accept that thing as the allowable expense. So the things which are not being accepted by the taxation authority now and even in the future will give rise to the permanent differences, and there is therefore no accounting for those permanent differences, no deferred tax consequences. We will be only dealing with the temporary differences, and that's it. And now I'm going to give you an example to understand what this temporary difference is all about. So I'll be giving you two examples. The one will be related to the liability, the deferred tax liability, and the other will be related to the deferred tax asset. So example number one, we are talking about the depreciation. So let's assume the cost of the asset is 100,000 and the depreciation is 20% straight line method. So the depreciation would be 20,000 and you will get the carrying amount. You'll get the carrying amount of 80,000, right? You'll get the carrying amount of 80,000. Now, we know that the tax authority does not accept the depreciation. Any one of you who have studied the F6 exam, they're already aware of it. That the tax authority does not accept the depreciation as an allowable expense. Instead, they give you the tax depreciation, which is known as the capital allowance. So let's assume the cost remains the same, 100,000, and the tax depreciation is 50%. Let's assume they have given you the rate of 50%. Now, 50% means you will be recording the tax depreciation of 50,000. And as a result, your tax base will be, the tax base is the figure for the tax purpose. Carrying amount is the figure in your books. Tax base is the figure which is being calculated for the tax purpose. So according to the tax base, you will be having an amount of 50,000. Now here you can clearly see that your carrying amount differs your tax base. Your carrying amount is 80,000 and the tax base is 50,000. Now I'm going to show you some analysis just for the understanding purpose. Assuming we have the profit before depreciation. Now profit before depreciation is actually not a something which exists in real. We do not see anything like that. We have the profit before tax, profit before interest, profit before interest and tax, but we never record something like profit before depreciation. This is something in order to understand the scenario. So assuming profit before depreciation. So the profit before depreciation is, let's assume 100,000. And then you are supposed to deduct the depreciation expense from it. So the depreciation expense is 20,000, right? So 20,000, you're going to deduct it. And now the profit after everything, net profit. So let me just call it net profit. Now the net profit is 80,000. You're supposed to make the tax payment on this 80,000. Now assuming 30% is the tax rate. So you were making the tax payment of 24,000. This was the amount that would be payable if your net profit is 80,000. But the scenario is that the tax authority is not accepting your 20,000 as the expense. And instead, they're saying you to record the tax depreciation of 50,000. Now, when you're recording the tax depreciation of 50,000, your profit is going to be 50,000. And when you multiply the tax percentage of 30% to the 50,000, you will get the tax expense of 15,000. This is the expense that you were expecting to pay, 24,000, but the taxation authority is not going to take the tax of 24,000. Instead, they are asking you to pay 15,000. Now, see, you are paying less tax. You are paying less tax due to the adjustment referred by the taxation authority. But it's a temporary difference. Even in the next year, you will be having depreciation of 20,000 and tax depreciation of 50,000. In the next year, according to the taxation authority, your asset will be fully depreciated. In the third year, you will not be having anything to subtract from the profit because you have already claimed the 100% of the tax depreciation, 50% in the first year, 50% in the second year. Now your asset has been fully depreciated. In the third year, you will not be having any amount to deduct from the profit figure. And you will be supposed to make the tax on the complete profit payment. So this is the temporary difference. Now, in the current year, the taxation authority is taking less tax from you. Because of the adjustment, they have suggested you that don't record 20,000 as an expense, record 50,000 as an expense. They suggested you more expense. That more expense has reduced the profit. And as a result, you are paying less tax now. But remember, when this adjustment will be over, because this is a temporary adjustment, you will be making the full tax payment. So how I should record this less tax consequence now? I should record this less tax consequence as a deferred tax liability. That due to this adjustment which has been suggested to me by the taxation authority, I am paying less tax today. But this is a temporary adjustment. In the future, I will be supposed to make the full payment when the adjustment is over. So the future consequence of this is that I will be making the tax payment. So you should record this future tax consequence now as the deferred tax liability. And the debit entry would be an expense in the profit or loss. This is the first example that you see due to the adjustment suggested by the taxation authority, you are paying less tax now, but this difference is a temporary difference. And this difference would be over soon. And the future consequence will be that you have to pay the more tax in the future when you will be having no amount to deduct from your profits. So the future tax consequence is that you have to pay more tax in the future. So now it should be recorded as a liability. Now I will be giving you the second example, which is the example of the provision. Now we know the provision is when there is a probable outflow and you record that thing as an expense, debit, profit or loss, credit provision, that simply means recording as a liability. So when you see the carrying amount, the carrying value, there is the negative figure over there because it's an obligation. So we are showing obligation in the form of the negative figure. And the tax base would be nil because the taxation authority does not accept it unless and until this expense has been paid. So this is an outflow which is probable, but it is not yet paid. The taxation authority does not accept it. Let's assume the figure is, for example, 15,000. So you have recorded this thing as a liability, as an expense, but the taxation authority is not accepting any amount related to that. Now, assuming the same profit before provision, there's nothing like that, but just for the sake of the example, that the profit before deducting the provision is 100,000. Okay, so the provision should be recorded as an expense. You recorded 15,000 as an expense, and your profit after provision would be 85,000. Now you are supposed to calculate the tax on the 85,000 because this is the net profit. But the taxation authority is not accepting this provision as an expense because they're saying there's no outflow yet. So you're supposed to make the tax payment on 100,000. So you see, when 85,000 is multiplied by the 30%, let me use my calculator and see what I get. So 85,000 multiplied by 30%, assuming the rate is 30%, 25,500 should be the tax. But the taxation authority is not accepting that figure. And this year you're supposed to make the tax payment on 100,000 because this is the expense we are not accepting right now because it is not yet paid. So according to the taxation authority, you are supposed to make 30,000 of the tax payment. Now, due to the adjustments suggested to me by the taxation authority, today I am paying more tax. But when in the future there will be an actual outflow, taxation authority will be accepting that thing as an expense. The future tax consequence is that I will be paying less tax in the future because the taxation authority will be accepting my figure when it is being paid. In the future, I will be paying less tax, but today I am paying more tax due to the adjustment suggested by the taxation authority. In the first example, it was different. You are paying less tax. You are paying less tax in the depreciation example. And the future consequence was that in the future, you will be paying more tax. Here you are paying more tax. And the future tax consequence is that you will be paying less tax. So how I should record this future tax consequence? I should record that thing as a deferred tax asset. Because now I am paying more tax. You can just simply see it as an advance tax. You're paying the tax in advance. So when you're paying the tax in advance, you should record that thing as an asset. So you're paying more tax now. In the future, you will be getting the adjustment. So you should record that thing as an asset. The credit goes to the profit or loss. So deferred tax, deferred tax is simply an adjustment related to. So deferred tax is simply the future tax consequences. Either you will be paying less tax now and you have to pay the complete tax in the future. So it should be recorded as a deferred tax liability. Or you're paying more tax now and the future tax consequences that you will be getting the relief in the future when that figure is being accepted by the taxation authority. So the future tax consequences that you will be paying less tax in the future. So today you should record that thing as the deferred tax asset.